Hello, everyone. You're welcome to the webinar on recent changes that affect international structures. And let's first of all try and make sure that everything is working. Please type pluses or click the fire button in the bottom right corner to make sure that everything is working and you can see and hear me. Yeah, we have pluses. Very good. So let's start. And before we begin, a few administrative notices. First of all, the most frequently asked question is whether we are going to circulate the materials. And the answer is yes. We are going to send to everyone who registered to these events the presentation and the recording of the webinar. It's going to take a few days to prepare the materials, but within a week we usually distribute the materials to all registered participants. That's one thing. Second thing, you're welcome to ask your questions. And yeah, if you would like to clarify something or have a question which is not addressed in the event, you're welcome to ask a question, and you can do it by clicking on the question sign in the upper right corner. There you will have a space where you can type in your question. So you're welcome. We are going to have a Q&A session at the end of the event. Okay, so these are the administrative matters, and let's a few questions about a few things about myself. My name is Viktor Kalgin, and I'm a tax partner at a company called KEPT, which is a former KPMG Russia firm. And my team and I, we help our clients, most of which are international companies with presence in various countries. We help to address tax challenges that occur in international landscape and in cross-border situations. So this is what we do. We consult, we advise clients on how to deal with difficult, complex tax issues that arise in cross-border situations in international business structures. This is what I do. And I will be speaking today, and I will be joined by a colleague of mine, Vsevolod Bude, who is a guest speaker. He's showing up, and please welcome Vsevolod. And would you like to say a few words to welcome the participants?
Good morning, everyone, and hi, Victor. So I'm the one specializing in the personal taxation.
Okay. Now I can hear you. Very good.
Yeah. So I'm the one specializing in the personal taxation. So we'll see each other in the second section of our webinar. So hope to see you there, and stay tuned. Thank you.
Yep. Very good. Thank you, Vsevolod. This is what's going. These are the speakers, and I will be in the first part of the event. And let's spend a few seconds to let me present you the agenda of today's events. The event is going to last for 2.5 hours, and we'll have two parts. In the first part, we'll address corporate changes that affect corporate structures. There will be four blocks, four subparts in the first part. In the first part, we'll have four subparts. The first one will be about Russian changes, and we will talk about tax treaties and what's going on and what's the perspectives are, how tax treaties are now work, how tax treaties work currently in Russia. Second, we will talk about international shipping, and we received lots of questions relating to international transportation, international shipping, and various withholding tax issues that our clients face in this respect. So this will be addressed. We will talk about recent trends and additions to Russia's blacklists of countries and how they affect international structures. And finally, in the Russian part, we will spend some time to discuss cross-border structures case law. We'll talk about a few recent arbitration court cases where cross-border situations were addressed by courts. Second, we'll talk about Kazakhstan, and we see lots of interest from our clients to this country, and we will discuss the upcoming tax reform. some recent changes in transfer pricing legislation, and also again here in the Kazakh part, we will also have an overview of cross-border structures case law. Third, United Arab Emirates. There is a tax reform which is ongoing in this country, and again we see lots of interest among our clients to this jurisdiction. This is why we are going to address what's happening there. And we'll talk specifically about recent tax guides that the Federal Tax Service issues in respect of recent, well, in respect of the corporate tax law. Yeah, we'll talk about free zones, free zone persons, corporate tax guides, and the guide that describes participation exemption rules. And finally, in the first part, we will conclude by looking at few developments that affect restructuring opportunities. Yeah, we'll talk how recent trends affect possibilities for for international companies to restructure, to change their structures. And we see again in our projects, we see lots of interest to changing historical structures due to, well, various developments, and to adapt structures to most recent trends. It is necessary from time to time to change them, and this is why this part is important. And we kind of usually we keep addressing changes that affect restructuring opportunities, and we'll have it this time as well. Next, we will move on to the second part, and I will pass the floor to Vsevolod, who will discuss recent changes in special tax regimes in various countries. As you can see on the slides, we will have a discussion about the recent changes in the United Kingdom, Portugal, and Spain, and some other countries. And second, we will come back to Russia, and there is a tax reform. There are tax changes that are underway, that are being discussed currently, that affects international personal asset structure as well. So this is the plan. And finally, as I said, we'll have a Q&A session at the end. This is the plan, and the agenda, as you can see, is quite dense. We will we'll have 2.5 hours to address all this, to make this plan happen. So without further delay, let's move on to the first section, which is about Russian changes. First of all, what are tax trends in Russia that affect international structures? I would say there are three. There is an upcoming tax reform, which is expected to affect profits tax, personal income tax, and provide so-called tax amnesty to so-called business fragmentation, which is the thing that's which is mostly relevant to small and medium enterprises. So it's not likely to affect the international structures that we mostly work with, but still, let's wait and see how the tax reform develops. Most important developments that affect international structures with Russian assets relate to suspension of tax treaties, which happened last year, expansion of so-called blacklists of countries, and introduction of withholding tax for service. We are going to discuss it in the first part in the Russian section. And finally, we see a lot of questions and issues that international businesses face in respect of international shipping and withholding taxation of various logistic operations, various logistic cross-border operations, and tax efficiency of supply chains is affected by well, first of all, introduction of withholding tax in relation to services, and taxation of international shipping operations in the context of recent suspension of double tax treaties by Russia. So these are the main trends, and we're not going to talk too much about the tax reform, apart from the last final part where Vsevolod will mention a few developments, few things that are planned in respect to the personal structures, but otherwise we will talk mostly in the Russian part on the recent developments in respect of tax treaties, international shipping, and various blacklists, as well as some case law. This is the plan. Let's start by talking about tax treaties and suspension of tax treaties by Russia. First of all, Russia still has more than 80 double tax treaties, And yeah, as most of you know, they provide for tax incentives and various exemptions. And most commonly used exemptions relate to withholding taxation of so-called passive income, namely dividends, interest, and royalties. And well, the good thing about tax treaties is that they provide either for an exemption or for a reduced withholding tax rate in respect to most types of passive income. Okay, last year in August, Russia suspended many double tax treaties. To be precise, 38 double tax treaties were mostly suspended, not in whole, but most articles, most provisions of double tax treaties were suspended by Russia, and this is the major development that affected many historical structures. And yeah, the link to the decree that's suspended tax treaties can be followed by clicking on the link on the slides when you receive the material. So it's in Russian, but you can familiarize yourself with the original documents. And we discussed these changes in February. We had a webinar on Russian tax developments and other countries' tax developments in February. And in particular, not only we discussed changes or suspension of double tax treaties and how they affect various structures, but also we looked at temporary incentives and exemptions that are envisaged by law and that can help temporarily to maintain historical tax efficiency of cross-border structures with Russian assets and operations. So you can look up, you can follow the link and look it up in the previous webinar. This time we will talk about various implications and why this is important. First of all, because Russia started to apply withholding taxes in many cross-border situations, in cases where treaties were suspended, and it became especially problematic given that Russia, in its turn, was blacklisted last February, was blacklisted by the European Union. In this context, depending on a specific country, it became either difficult or impossible to credit the withholding tax against the tax liability in the other country. In many instances, withholding tax may not be a problem, or kind of can be the impact is to some extent decreased by the possibility to credit withholding tax. But unfortunately, since Russia is blacklisted by many countries, including the European Union, this credit became unavailable or became much more complicated. And another thing that followed the suspension of the tax treaties is that different countries reacted differently, and so we'll talk about it in a few seconds. But some countries decided to terminate their tax treaties with Russia, and in turn, some Russian exemptions and domestic rules, they are dependent on the existence of a tax treaty with a specific country. For example, some CFC exemptions, they are only granted to companies that are located in countries with which Russia has an existing double tax treaty. So termination of double tax treaties affected some domestic rules and exemption on the Russian side as well. So this is why the suspension of double tax treaties by Russia is important, and it affects historical structures. So what happens since February and over the last few months was that different countries, in one way or another, reacted to Russia's suspension of double tax treaties. And in April, Finland announced that it's planning to keep applying the Russia-Finland double tax treaty, which is obviously a good news, because whenever other country faces a question how to treat cross-border payments and transactions with Russian counterparties, it is necessary to understand what the other countries' position on the suspension of double tax treaties by Russia. And Finland decided to keep applying the tax treaty with Russia, which means that on the Finnish side, structures with the Russian assets maintain their tax efficiency, or at least the impact is, to some extent, is not as dramatic as it could have been otherwise. Austria, on the other hand, decided to suspend the treaty. So Austria's answer was more or less symmetrical. And a few countries, including the Czech Republic and Austria, they noticed that the way the suspension was made affected the possibility to apply withholding tax credits, which is, again, complicates how the newly how withholding tax, which resulted in the after the suspension, can be utilized and credited. That was in some countries' response. For example, Austria and the Czech Republic, they commented on the suspension this way. So, as you can see, other countries' responses vary, and there are basically three main ways how other countries react to Russia's tax treaty suspension. Some countries decided to terminate double tax treaties with Russia, and this includes Denmark and Ukraine. Some countries declared that they suspend tax treaties, and this includes Austria and the Czech Republic. But many countries decided to continue to apply tax treaty benefits, which is, again, good news. And this response is most common. And publicly, it was some time ago, many countries announced that they continue to apply double tax treaties. This includes Germany, Switzerland, Finland, as I said on the last slide, the United Kingdom, Hungary, and Cyprus. They declared that they are going to continue to apply double tax treaties with Russia, which is good news. There are some new tax treaties that Russia is concluding. First of all, as of this year, a new double tax treaty with Oman is in force, and it provides for reduced withholding tax rates, and this is so-called triple 10 approach, where dividends, interest, and royalties are subject to withholding tax at a rate of 10%, which is reduced compared to the domestic rate. In Russia's domestic rates to interest and royalties is 20%, and for dividends it is 15%. So the reduction is not an exemption, but still it's a considerable reduction. And this is the new approach that Russia takes to when it negotiates treaties with other countries. However, some older treaties they provide for greater reduction. Some treaties, for example, allow to withhold tax at a rate of 5% on dividends and envisage for exemption in relation to interest and royalties. But new treaties, such as the treaty with Oman, they provide for 10% withholding tax for each of the three main types of passive income. Long-awaited double tax treaty with the United Arab Emirates is still under discussion, and the key factor seems to be the position of the United Arab Emirates that disagrees to apply to sign a new treaty with the triple 10 withholding taxes for interest, dividends, and royalties in a situation where Russia has more favorable double tax treaties, all the ones with Qatar and Saudi Arabia, for example, where dividends can be subject to 5% and other income can be either exempt or subject to lower than 10% withholding tax rate. The United Arab Emirates seem to think this is not fair, while other Gulf countries have access to more beneficial rates. This is why Russia proposed to renegotiate treaties with Qatar and Saudi Arabia. And we should wait and see how the situation develops, because it's not clear whether and when other double tax treaties with well, other Gulf countries can be renegotiated. And since the position of the United Arab Emirates depends on the outcome or depends on these negotiations, it's not yet clear when and even whether a new double tax treaty with the United Arab Emirates will be agreed upon. But we'll see. And finally, this year, Russia signs a new double tax treaty with Malaysia, which is going to apply starting next year. Again, 10, 10, and 10 are the rates for dividends, interest, and royalties, which is not surprising. Yeah, there is a new treaty there. Okay, so to conclude, before we move on to the next section, we see a trend among our clients. We see a trend of shifting and changing the historical structures with Russian assets to replace formerly commonly used companies that are located in countries with which now Russia has tensions and which Russia blacklists, or which in their turn blacklists Russia. This includes European Union. We historically saw a lot of holding and operating companies dealing with Russian companies. But yeah, recent developments, they force businesses to change their historical structures and to move to so-called friendly jurisdictions, countries which are not blacklisted by Russia, which includes, and yeah, the most common examples includes the United Arab Emirates, Hong Kong, and Kazakhstan. And this is why we have Kazakhstan and the United Arab Emirates in this event. We are going to talk about changes there, and it's not surprising because we see more and more attention among our clients to these countries. And about Hong Kong, for example, a couple of months ago, we had a separate event and discussed tax changes there. Okay, let's move on. And the next section is international shipping. Again, the developments in Russia affected cross-border structures, and there are reasons why it is important. First of all, international shipping income that Russian company pays to a non-Russian company, it is subject to withholding tax in Russia. So international shipping income, although for many years Russia had not taxed services, there were types of service that were subject to withholding tax, and international shipping income, international shipping service was one of the examples. So international transportation services used to be and still are subject to withholding tax in Russia. This is one thing. Last year, as again I already mentioned, in August, Russia suspended tax treaties with various countries, and since international shipping used to be subject to exemption under tax treaties that were in force, this suspension caused dramatic change in the way how international shipping operations were taxed in Russia. Again, tax credits of the tax withheld became more problematic. And yeah, finally, starting this year, Russia started to tax services at source, and this is the fourth reason why. And it's not uncommon to see in supply chain operations in various logistics chains that not only international shipping is present, but other services as well. And these services became subject to withholding tax. Yeah, this is where we are, and this is the context of this question. So let's look at a simple example. We see a Russian company on the slides and a non-Russian supplier. If the supplier supplies goods and provides shipping services, then the payments may be subject to withholding tax in the part that relates to shipping services. Provision of goods, sale of goods is not subject to cross-border sale of goods is not subject to withholding tax in Russia yet, still, but services, including international transportation, is now subject to withholding tax. This is why it is important. There are treaties that Russia still considers in force, and this includes Russia-China Treaty, where Article 8, and this is the most common structure of treaties, where Article 8 addresses international shipping, international traffic. And on the slide, it is seen that income from international traffic should be taxable only in the states where the company that provides that the service is a tax resident. This is very common composition of Article 8, and yeah, which means that if the service provider that receives income from international shipping operations from Russia is in a treaty country, as for example China, then even regardless whether a permanent establishment exists, we are all used to situations where permanent establishment gives the rights to the country, to the source country, Russia in this case, to tax income, but international traffic, international shipping is an exception, even if in this case a Chinese tax resident that provides international traffic services has a Russian PE for some reason, then even regardless of this PE, income should not be subject to tax in Russia. Okay, this is the way how double tax treaties work, and those treaties that are still in force, they provide for an exemption from withholding tax in Russia in relation to international shipping income. And this was reminded by recent clarification by the Russian Ministry of Finance, reminded the main principles of taxation of international shipping income. So in the letter that was issued in December last year, the Russian Ministry of Finance discussed a situation where there is a German company that received income from international shipping, and the ministry reminded that in August the double tax treaty between Russia and Germany was suspended, which means that the withholding tax should be should apply in to income that the German company received from international shipping from Russian source. Another point, and this is an important one, is that the ministry reminded that so-called freight forwarding or forwarding services should not be subject to withholding tax, at least at the time when the letter was issued in December last year. Services were yet not subject to withholding tax, which meant that freight forwarding services, which are sometimes present in international shipping operations, they are different and they should not be subject to tax at source, which is important. And on this basis, at least some parts of consideration paid to in this case to the German company should not be subject to withholding tax, provided that there are last year it was not subject to withholding tax based on domestic law. So even supporting documents such as tax rate certificates were not required. No, this is important. Next, the ministry reminded that as of January this year, services should be subject to withholding tax, but only services that are service fees that are paid to a related party. So only intragroup services are subject to withholding tax, and the applicable rate is 15%. And we looked at this change in more detail on a webinar in February, so you can look it up following the link on the slide when you receive the presentation. And and the ministry also reminded that there are some temporary exemptions relating to old contracts and that apply to shipping operations as well. So let's consider a few examples. So we see numerous changes. First of all, suspension of double tax treaties. Second, introduction of withholding tax to intragroup services, and a distinction between international shipping and freight forwarding services. All these kind of developments and differences can affect how a specific international structure, logistic structure, is subject to tax in Russia. So we'll look at 5 cases, and on this slide, there is a structure where a non-Russian company receives income from international shipping, and the company the non-Russian party is located in a country with no double tax treaty with Russia, or with which the double tax treaty is suspended. In this case, there is going to be withholding tax, simply because in the absence of a double tax treaty, international shipping is subject to withholding tax in Russia. Next example. Let's look now at a situation where there is a the non-Russian party is in a country with a double tax treaty with Russia, which is still in force. In this case, provided that there are supporting documents such as tax residence certificates and confirmation that the non-Russian company is the beneficial owner of this income, it is possible to apply the exemption under the double tax treaty, which means that if the non-Russian party, the non-Russian service provider, is in a country with a double tax treaty with Russia, no withholding tax should be due, provided that everything is done properly. Next example. If instead, again, there is an unrelated party, and we are talking about current rules, there is an unrelated party that receives services from freight forwarding, that provides freight forwarding services to a Russian company, which in turn pays the consideration for this service. In this case, there should be no withholding tax because, based on domestic law, services to unrelated parties, they are not subject to withholding tax. Only starting this year, only related party income of a non-Russian company is subject to withholding tax if this is service income. Okay. Next example. If there is a related party to the contrary, then any services, including freight forwarding services, are subject to withholding tax if there is no treaty or the treaty is suspended. And finally, if there is a country with a double tax treaty, then even if this is a related party that receives income from services in Russia, in this case, provided that there are supporting documents and there is no permanent establishments in Russia of this related party, then no withholding tax should be due because treaty benefits apply. We are talking about a situation where Russia taxes applies withholding tax to services provided by the related party, but the double tax treaty allows to exempt these payments from withholding tax in Russia. And here we will answer a question that's we received before the webinar. I'll read it out. Under a transportation agreements with the Chinese residents, should we withhold tax on income from a Russian source if the double tax treaty with China only specifies sea and air transports, and we have road transportation? So we're talking about specific type of international shipping, and it is not by means of sea or air transport, but it's by means of road transportation, automotive transport. And the answer lies in Article 7 of the double tax treaty between Russia and China. And as usual, this article describes active income or so-called business profits, and we can even highlight the relevant. Let me see the relevant provision of the. Just to make sure that the relevant provision of this article. So the profits of the company, in this case of the Chinese company, may be taxed in the other country, but only to the extent they are attributable to the permanent establishment through which business in the other countries carried on. So the conclusion here is that if there is no permanent establishment of the Chinese company that receives income from international shipping by means of road transportation, we fall under this provision, under this article. And as long as there is no permanent establishment, then no tax should be due. Again, provided that the treaty applies, because we need to make sure that the treaty is in place and that the company is indeed a tax resident of the other country, China in this case. This is why we will need tax credit certificates and a confirmation that the company is the beneficial owner of this income. But if everything is done properly, then the conclusion is that there is no withholding tax in Russia, despite the other party receives income which doesn't fall under Article 8 international transportation. This is fine because income falling under Article 7 is exempt from source as well. But the difference is that, we'll need to make sure that there is no permanent establishment in Russia of the company that receives income. This is the difference between Article 7 and 8 in most double tax treaties and in the model tax convention on which treaties are Russian treaties including are based. Okay, so it's time to draw some conclusions from what we discussed about international shipping. First of all, international shipping services are subject to tax in Russia. It will be risky not to withhold tax if there is no treaty protection, if there is no treaty in place, although some recent case law developments suggest that in some cases companies managed to prove that international shipping should not be subject to withholding tax in Russia. But this case law is still developing. It's not something that I would recommend to rely upon, although it can be looked at more carefully, or at least it should be monitored. But the main principle is that shipping services are subject to withholding tax in Russia. Second, in most cases, if there is a double tax treaty in place, then it is possible to avoid withholding tax. And finally, there is a possibility, at least to some extent, and if it reflects the reality, that if the service is actually not international shipping but freight forwarding, which is different in my estimation, the difference between international shipping and freight forwarding is the difference between doing and organizing. If there is a shipping company, but there is an intermediary that organizes transportation on different stages, then this intermediary actually receives freight forwarding income. This is going to be based on some common logic and how it looks like the difference is made. Distinction can be made between the two types of situations, two types of services. Okay, so if instead of international shipping income, the non-Russian company receives freight forwarding fee for freight forwarding services, it's not going to be subject to withholding tax as long as the non-Russian company is an unrelated party, because there is no taxation of unrelated party services in Russia yet. Okay, so there are the conclusions. Here are the conclusions, and let's move on to the next section, which will be about blacklists of countries. And we will not spend too much time on the blacklists. I will just say that there are multiple blacklists that Russia conducts and kind of maintains. There are 4 that are shown on these slides. Let's talk about them one by one. The oldest one and which seems to have the most effect on cross-border structures is the list that is maintained by the Ministry of Finance, which is called the list of offshore zones, which was updated recently, and we'll spend a few minutes to talk about the change. Second, the Federal Tax Service, the Russian Federal Tax Service, also conducts and maintains a list of countries that do not exchange information. Again, the link can be found on the slides. It's in Russian, but you can translate and see what countries are in this list. Third, there is another list that the Ministry of Finance published a couple of years ago and maintains only for various states' support measures and subsidies that are not allowed to companies that are owned by holding companies that are located in countries that the Ministry of Finance refers to territories used for intermediary ownership. Again, it has limited impact if your company doesn't receive doesn't receive subsidies from the state, from Russia, which are common for example, in agricultural industry. But if it's not the case, then you are fine. You do not have to monitor the changes to this list. And finally, the Federal Tax Service conducts lists of countries that provide for automatic exchange of information with Russia for CRS and country-by-country reporting purposes. Okay, so let's talk about the first list. And again, we'll not discuss all tax incentives and exemptions that this list is used for, but yeah, there are a few, and the most important one, again, here for cross-border structures is the exemption, which is used to finance Russian subsidiaries by multinational companies. If there is a Russian company that has a subsidiary, or vice versa, if there is a non-Russian parent company that would like to finance its Russian subsidiary, then it is important that the parent company is not in the country that is blacklisted by the Ministry of Finance, and we'll talk a bit later about the list and how it is applied. But provided that the company is not in the country that is blacklisted, then the exemption can apply to free of charge transfers of assets and money, for example, which is a common type of which is a common way to finance Russian subsidiaries by multinational companies, by their parent companies, foreign parent companies of Russian subsidiaries. Okay, so this list, it was last year. It was significantly expanded in June. A new version was published with 91 countries instead of 40 countries previously. And it began to apply starting this year, this expanded new list. However, there is a temporary list which is much shorter and basically contains the same 40 countries that were in the old list before the expansion, which still applies to many types of exemptions until the end of 2026, which is obviously good news, because otherwise the various exemptions, and including the free of charge transfer that I mentioned, we're not going to apply. So again, on this slide, we can see the list of exemptions that are based on the blacklist of countries published by the Ministry of Finance, and the temporary list, the shortened list, which is a much better version of the list, applies to the list of these exemptions, including the free of charge transfer of goods and so-called property rights, which includes money. Okay, which is good news. Until the end of 2024, it's possible to still to continue financing Russian companies from countries that are included in the main version of the expanded, in the main version of the list, in the expanded list, where again there are a few exemptions, there are a few provisions that already that are already based on the long list, on the expanded list. And again, for multinational businesses, multinational companies, this last rule, that transactions that are subject to transfer pricing control if they exceed a specific thresholds of 120 million rubles, which is just above $1 million. And again, regardless whether the other party is in fact a related party, still transactions with unrelated parties that are located in countries that are included in the expanded list, they are deemed to be controlled starting this year, which means that there are compliance requirements. There should be transfer pricing justification and transfer price documentation in place. Yeah, again, so this is important. Hopefully, it doesn't mean that transaction prices should be adjusted, but even in unrelated party situation, there should be some compliance, transfer pricing compliance requirements to be met in this situation. Okay, let's move on. As I said, there is a blacklist of countries that is published by the Russian Federal Tax Service. It was expanded, but not as dramatically as the Ministry of Finance's blacklist was. It includes the Federal Tax Service list includes some unfriendly countries, for example, the United States, the United Kingdom, Canada, Switzerland, and a few others, but not all so-called unfriendly states, which is good. What's the main purpose of this list is this list is mainly used for CFC purposes and also for some personal income tax incentives, which means that in most cases, well, multinational companies with Russian subsidiaries with Russian assets are not going to be affected. But still, it's worth monitoring this list as well. If you, for example, have subsidiaries of Russian companies and you are responsible to file and apply CFC rules and exemptions based on various provisions that are linked to the blacklist of countries published by the Russian Federal Tax Service. Okay, and two more blacklists to finish this section. Again, as I said, there is a list published by the Ministry of Finance for subsidies, state subsidies and investments, which is not that widely applied. And there are a list of countries that the Russian Federal Tax Service considers to comply with automatic exchange requirements. And for example, if the country is not on the list of countries that provide for automatic exchange of country-by-country reports with Russia, in this case, there may be instances where secondary filing is required. Secondary filing of country-by-country reporting, country-by-country report is required in Russia if the country was included in the Federal Tax Service lists, and which means that the reports filed in the home country are not exchanged with Russia, in which case Russia requires secondary filing of such reports. Okay, so what are the conclusions? It's time to draw the conclusions. First of all, the list of offshore zones published by the Ministry of Finance almost doubles, but there is still a shortened version which is in place until the end of 2026, which is used for most tax incentives and benefits. The Federal Tax Service updated its list, but it's mainly applicable to CFC rules. And finally, some other blacklists exist, but they have much limited effects on typical cross-border structures. But again, you may be required to file a secondary CBC report if your parent company is included, or the parent company is in a country that is included in the list of countries not providing for automatic exchange of CBC reports with Russia. And finally, in the Russian section, we'll talk about recent case law. Again, briefly. First of all, there is a case where the courts addressed CFC claims or penalties for failing to submit financial statements of non-Russian companies by Russian parent company. But although the tax authorities charged fines and penalties for failure to submit such financial statements, the taxpayer managed to prove that it was not its fault, and the failure to submit was due to circumstances beyond the control of the taxpayer, which led to cancellation of the tax authority's decision to charge penalties for non-disclosure, non-compliance with CFC rules. Next case is where the court considered a situation where interest was capitalized and kind of attached, or it was transferred. So it was modified so that it becomes part of the loan principle. It's interest capitalization. It's not uncommon, and the court decided that it should trigger withholding tax, and if interest capitalization takes place, then withholding tax should apply to interest which was not actually paid but instead capitalized, which is not surprising. This is This is the outcome which one would expect from such situation. But the taxpayer decided to dispute the charge, the withholding tax charge, and quite predictably lost the case. And finally, there was a case where the court considered tax credits of tax withheld. Russian company received income from abroad, and it was subject to withholding tax in the other country. But the Russian company was loss-making in the periods when income tax was charged was withheld at source. And unfortunately, the taxpayer was not able to credit this withholding tax, and the court agreed that it's not creditable in the periods when losses were incurred, and there is no withholding tax credit carry forward rules in Russia. This is why effectively this withholding tax is lost. And the conclusion here is that it's best to receive income in periods, best to receive income subject to withholding tax outside Russia in periods when the Russian company receives profits against which this withholding tax can be credited. Okay, so let's move on. This was the Russian part, and we are now moving on to Kazakhstan. This is the second part, and we will have other sections relating to the United Arab Emirates and some developments affecting restructuring opportunities before we proceed and move on to the second part about personal structures. Okay, a few trends in Kazakhstan. First of all, again, the tax law is going to change, and there is an upcoming tax reform in Kazakhstan. There are changes that affect transfer pricing rules, and there is some arbitration case law relating to cross-border transactions. We will talk about these three developments. First of all, it is expected that again tax rules in Kazakhstan will change. It's likely that the changes will affect personal and corporate income taxes. There were discussions about changing of the VAT rate from 12% to 16%. It doesn't seem likely, but we'll have to wait and see. And from what is currently known, it doesn't look like cross-border structures are going to be too much affected. Although over the recent years, tax changes in Kazakhstan, they indeed significantly affected cross-border structures. For example, there was change to the withholding taxation of dividends. The 3-year exemption was abolished, and also there were developments in relation to deductibility of cross-border related party service fees. But we'll have to wait and see if the new changes will affect cross-border situations. Obviously, if the corporate income tax rate is increased, it is going to affect structures with assets in Kazakhstan. But otherwise, let's wait and see. There are not much detail available yet, but maybe in a few months we'll see what the changes may look like. And we considered various changes in Kazakhstan in previous events, and there are links here on the slides. You can look at the changes and solutions that we discussed in the context of tax changes in Kazakhstan in 2022 and in February this year. Let's move on. Changes to transfer pricing rule. Again, this is not the area of my expertise and the expertise of my team. We'll only consider it briefly, but given that transfer pricing rules in Kazakhstan, they have been in place for a long time and they affect cross-border transactions, it's important to monitor these developments. And the law was adopted recently in March, and it's already put into force. And what are the main changes? First of all, the scope of controlled transactions is no longer limited to supplier goods, work, and services. So, for example, loans may be subject to transfer pricing control, sale or transfer of intangible asset shares, and etc. So that kind of hopefully puts an end to a long debate whether, for example, loans should be subject to transfer pricing control. Sale of intangibles is controlled for transfer pricing purposes. Second, some domestic transactions are now going to be subject to control. For example, if one party is a subsoil user and the transaction is somehow linked to international operations. Next, now a strict hierarchy of transfer pricing methods has been abolished, and comparable and controlled price methods is still the priority method, but otherwise other methods, they have kind of they should be it should be in each particular situation should be decided which transfer pricing method addresses the particular situation best. And finally, the interdependency criteria, the interdependency conditions were expanded, and there are now situations that make some unrelated party transactions subject to transfer pricing control. Okay, let's now move on and look at cross-border cases in Kazakhstan, and we'll have three. The first one is about transfer pricing adjustments and its recharacterization into dividends. This is an interesting case. What we see here, there was a supply of natural gas from Kazakhstan to a related party in China, and the supplier in Kazakhstan adjusted its price for corporate income tax purposes and paid additional corporate income tax. So it decided that the transaction, that the supply was not at arm's length, and the income, the company's taxable revenue should be adjusted to include additional income. Well, the tax authorities decided that in addition to the corporate income tax that was paid based on the increase of the price, on the adjustments, on the transfer pricing adjustments, there should be dividends recognized for withholding tax purposes and applied a domestic rule of 15%, which is not surprising, because in Kazakhstan there are so-called constructive dividends rules, which mean that basically if a specific transaction is not at arm's length, if the supply of goods from Kazakhstan abroad in a controlled transaction is below fair market value, then not only income should be adjusted and additional corporate income tax should be paid, but also withholding tax. Well, there are deemed dividends in relation to this transaction, because, well, obviously, if the company transfers a valuable asset at a below market value, economically it can be seen as distribution of profits, and there are rules to address this called constructive dividends rules. And the tax inspectorate, based on the price adjustments, decided that withholding tax should be paid and charged the dividends withholding tax at a domestic rate of 15%, despite the treaty between Kazakhstan and China, which is in place, allowed to apply a reduced rate of 10%. But the tax authorities denied these treaty benefits. Several court instances supported the tax authorities' decision, but the Supreme Court returned the case back to the first instance, and the first instance court decided in favor of the taxpayer and concluded that instead of 15%, 10% withholding tax should apply. And therefore, the conclusion is based on the principle that the constructive dividends can be subject to withholding tax at a reduced rate if the imputed dividends are considered are deemed to be paid to a company that is located in a treaty country with a double tax treaty that allows for reduced withholding tax rates for dividends, which is obviously good news. So the bottom line here is that treaty benefits can apply to constructive dividends, which can only be this conclusion can only be welcomed. Next case, we see a situation where there were multiple parties, as is shown in the slides. First of all, there is a Turkish, presumably parent company with a subsidiary in Kazakhstan, and there is a bank in Kazakhstan that provided loan to the subsidiary But the parent company, the Turkish parent company, had to guarantee the obligations of the subsidiary towards the bank. The obligation to repay the loan was guaranteed by the parent company in Turkey. And yeah, the rules in Turkey apparently require that such a guarantee is subject to stamp duty in Turkey. Okay, this is what it is. But the Turkish parents asked the subsidiary to compensate the stamp duty, and there was a payment from Kazakhstan to Turkey in relation to the stamp duty cost. So the subsidiary reimbursed the stamp duty. The tax authorities decided that this payment relates to loan and should be treated as interest and subject to withholding tax at a rate of 10%, which is the rate between which is the rate applicable to interest between in accordance with the double tax treaty between Turkey and Kazakhstan. But the taxpayer disputed the decision, the tax authority's decision, and won. The court said that despite the payment was made, it was not actually income, and it was not payments to. It was not paid to the lender, which means that it shouldn't be characterized as interest and should not be subject to withholding tax in Kazakhstan. Again, the conclusion seems to be reasonable, and again, the positive outcome can only be welcomed. And finally, there is a royalty case where there is a company. There was a company in Kazakhstan that paid technical support services and software development services to a UK and the Russian company, respectively. And it's not uncommon to in Kazakhstan to recharacterize service fees into royalties, and that happens in this case. So the tax authorities charged withholding tax at the domestic rates of 15% on both types of consideration for software development and technical support. Initially, this dispute was resolved in favor of the tax inspectorate that supported the decision, the qualification of service fee payments as royalties, but the Supreme Court returns the case back to the previous instance that rules out that the technical support fees should not be treated as royalties, but so under the contract between the party in Kazakhstan and the UK company, no withholding tax should apply, but in relation to payments from Kazakhstan to Russia for software development services, still withholding tax should apply, but at the domestic rates of 10%. Again, okay, well, this is somewhat controversial, and we see different instances where the tax authorities in Kazakhstan try to requalify service payments into royalties, because royalties are subject to withholding tax, and there is no double tax treaty between Kazakhstan and another country where less than 10% of withholding tax applies to royalties, which is why it's not surprising that the tax authorities seem to be incentivized to requalify services into royalties, but this practice is developing, and it's not always the tax authorities win, as is shown in this case. And there was a question from one of the participants to the webinar, and the question is about practice of beneficial ownership in Kazakhstan. Again, the question is reasonable because, for example, in Russia, we have seen this practice developing for almost 10 years already, even more. And yeah, there is a well-established practice of denying withholding tax benefits based on the beneficial ownership concept, where there is a non-Russian company that receives, for example, income and claims treaty benefits, but the Russian tax authorities argue that this company is not a beneficial owner, but instead is a conduit company, and then the income is in fact paid to another company that is not allowed to receive treaty benefits. Well, in Kazakhstan, what we now see doesn't look like this practice is as developed as it is in Russia. There were a few instances where this beneficial ownership concept was applied, and we see more and more interest from the tax authorities in Kazakhstan to cross-border situations and treaty benefits. But so far, it looks like in practice, the approach is more or less formal, as it used to be in Russia before. This practice started to develop. This is why if there is a tax resident certificate in place and, well, formal requirements are met, then it is likely that tax treaty benefits will apply. But obviously, the situation will develop, and we see how neighboring countries, how they kind of adopt practices that's proved useful for the tax authorities in Russia. And it will be not surprising if this concept, the beneficial ownership principles, will become more and more used and become more developed in Kazakhstan. So let's wait and see. Let's move on to the United Arab Emirates. Again, as I mentioned in the Russian part, we see more and more businesses change their historical structures and move their functional companies, holding companies, to so-called friendly states that Russia doesn't consider, well, which Russia doesn't restrict in terms of treaty benefits and, well, payments and other restrictive measures do not apply, and that includes the United Arab Emirates. This is why we see more and more businesses establishing presence, more and more clients of ours establishing presence in this country. And for example, given that the United Arab Emirates have good treaties with many countries of the former USSR, this, for example, includes Kazakhstan, Belarus, Uzbekistan. It's not surprising that the United Arab Emirates is more and more commonly used as holding company, like as a holding company location, as a location for a trading company and for other purposes. This is why we pay close attention to the ongoing tax reform in this country. And yeah, what we saw over the last few months is that the Federal Tax Service of the United Arab Emirates continued issuing guides on corporate income tax. And yeah, as many of you know, last year, new corporate tax law started to apply. And since that time, almost 20 guidances were on various aspects of corporate tax were published by the Federal Tax Service. And there is a link here on the slides to the complete register of issued guides, which can be followed. But in this webinar, we will talk about a few guides, and the most recent one, which attracted a lot of attention, is the guides, the so-called free zone persons guides that addressed and explained various taxation and compliance obligations for residents in free trade zones in the United Arab Emirates, and we are going to discuss it as well as an example as rules, as one rule for exemption of dividends and capital gains that we will look at from the guides that was published in October last year relating to participation exemption in the United Arab Emirates, which is applicable to both free zone companies and so-called mainland and the mainland. Again, so these guides will talk about the 12-month holding periods. And yeah, we are going to talk about subject to tax requirements. That is one of the requirements in the participation exemption rules in the United Arab Emirates. And finally, another interesting guide relates to business restructuring, and we will, in the last section about business restructuring opportunities, we'll talk about tax relief applicable to transfer of assets between companies in the United Arab Emirates, which is addressed in the business restructuring guide published in April 2024, in April this year. Okay, so free zone persons corporate tax guide. We'll talk about three things that can be derived from this guide. First of all, substance of a holding or investment company. Second, the 12-month ownership period rule, and whether it is necessary for a company that is located in a designated zone and applies the 0% corporate income tax rate based on one of the qualifying activities, whether it is necessary to import goods for such a company into a designated zone in the United Arab Emirates, or alternatively, this company, this distributor, can trade internationally without goods having to enter the United Arab Emirates. Okay, before we talk about substance of a holding an investment or investment company, based on a few examples from the free zone persons corporate tax guide, let's answer the question. The question is, what free trade zones provide for the 0% corporate tax rates? And this question basically demonstrates that we all need to be mindful of principles how the 0% corporate tax rate applies. And there are basically four. They need to be remembered. First of all, it's possible to apply, to use the 0% rates in any free trade zone in the United Arab Emirates. Second, the rate, the exemption basically applies to a company that carries out only or mainly qualifying activities. So again, it's not dependent on a specific free trade zone, but rather on the activities of a specific company. And the activities needs to be of certain type, so that the exemption applies. Third, if non-qualifying income exceeds certain thresholds, then the whole revenue of the company may not be subject to the exemption. So this means that in any free trade zone where activities are conducted and qualifying income is received, it's necessary to monitor and to avoid breaking the thresholds of stepping over the thresholds for non-qualifying income. Otherwise, the exemption is not going to apply at all to the whole revenue of a free trade zone company. And finally, there are other conditions, including proper substance and compliance with trust and pricing rules. And the first example, the first part of the discussion will be about substance requirements, and specifically about substance requirements relating to a free trade zone company. So this is an extract from the law that describes the conditions that needs to be made so that the exemption applies. And the first condition is that it's necessary to maintain adequate substance in the United Arab Emirates. So this is the requirement that needs to be met. Otherwise, the exemption does not apply. Some more guidance can be found in another document, in so-called in a cabinet decision issued last year. And what it states is that it addresses substance requirements, one of which is that core income generating activities should be conducted in the corresponding free zone. And there is a requirement, there are requirements to have adequate assets, adequate number of qualified full-time employees, and I would stress the full-time parts in this requirement, and yeah, and incur adequate amounts of operating expenses. Okay, obviously the term adequate is subjective, but it can be inferred from the description that at least there should be at least one full-time employee. Otherwise, it can be concluded that the requirement to have full-time employees is not met, and the substance requirements are not met, which means that the exemption, the corporate income tax exemption, does not apply, which obviously is not a desirable outcome. And we'll look at what the guide says. The guidance says about substance requirements relating to holding and investment companies, holding and investment activities. First of all, as is shown on the slides, there can be companies in the United Arab Emirates that have subsidiaries as well as manage investment portfolio. And such companies, if they receive investment income, for example, dividends and coupon payments on bonds. If they receive capital gains from sale of subsidiaries or securities, they can qualify for the exemption called holding of assets, holding of shares and other securities. So subsidiaries, shares and subsidiaries, and income from these shares, which includes dividends and capital gains, as well as investment portfolio consisting of various different securities and generating similar types of income. These types of income can be exempt in a specific free trade zone if the company qualifies for the condition to carry out carrying out activities called as holding of shares and other securities. So this is important. What the guidance tells us. There is an example where a holding company is described, and what's important about this example is that the holding company in the United Arab Emirates only has a small office. It's explicitly stated in this example, and it doesn't have any employees. Okay, so already it's disturbing, because if there are no full-time employees, one might say, the tax authorities might say that the company doesn't meet substance requirements. But despite there is no operational substance, the decision-making by the board of directors takes place in the free zone during both meetings in the company's office. So this is what the example says, and the conclusion is positive, despite there are no full-time employees, which may not even have enough to do for a holding company which doesn't actively trade its investments and doesn't dispose of or acquires subsidiaries. Despite that there is no such full-time employee, the conclusion is positive. It's sufficient to have a small office and from time to time make sure that core income generating activities are made in the United Arab Emirates by the board of directors, which conducts meetings in this small office. Okay, so this is a positive outcome. Conclusions here is that holding and investment companies do not have to employ a full-time person to meet the substance requirements. It's sufficient to periodically hold meetings in the company's small office in the free trade zone. But still, it's important to remember that the company's core income generating activities should be carried out in the free trade zone, which means that the board of directors, whenever it takes decisions in respect of the company's activities, needs to be present in the free trade zone. Otherwise, it can be argued that the company does not carry out its core income generating activities in the free trade zone, which is required, which is one of the requirements, which is one of the substance requirements for the corporate income tax exemption. Okay, let's go back to the structure with a company in the United Arab Emirates, in its subsidiaries and investment portfolio. And another condition for the exemption of income from corporate income tax, income from subsidiaries and investments, and shares and other securities, is that the holding period exceeds 12 months apparently for each individual security. And there was a question before the guidance was issued if it's indeed necessary for each individual instrument and security to exceed this 12-month holding periods. Or, for example, the portfolio as a whole can be traded in a way that's, well, more active, but the portfolio as a whole keeps kind of its existence for a period longer than 12 months. First of all, let's look at the definition of investment activity that was published last year. And here we see the condition, the 12 months condition. Shares and other securities are deemed to be held for investment purposes when held for an uninterrupted period of at least 12 months. So this condition was present. And what the guidance told us is that the active trading of shares would not constitute qualifying activity. in other words, here is the uninterrupted period of at least 12 months should be met basically for each individual instrument, which is not a favorable conclusion, not a favorable guidance, but at least it provides certainty. If a specific share or security is disposed of before it's held for 12 months, then this income is not likely to be considered as qualifying income, which means that income from this share, for example, from the sale itself, which means that, this income will fall under the so-called bad income or non-qualifying income category. And if it exceeds the threshold of either 5 million dirhams or 5% of revenue, of the company's revenue, whichever is lower, then the whole income, the whole revenue of the company is not going to be subject to the corporate income tax exemption, which is a pity, obviously. But the example which is provided in the guidance further reinforces this conclusion, and it describes different types of income, different income that the company receives. And ultimately, the conclusion is made that as long as each instrument individually was held or intended to be held for a period exceeding 12 months, then the income from each instrument falls under the qualifying income category, and the qualifying activity condition is met by the company. If it was not the case, then the conclusion would be different, and the company could have been not subject to the corporate income tax exemption otherwise. So conclusions here. First of all, holding of shares and other securities for investment allows investment activities in a wide range of financial instruments. For example, this includes options, bonds, and even cryptocurrency, which seems to be a broad definition of qualifying activity and instruments that can be held under the holding of shares and other securities exemption. However, each individual instrument should be held for at least or more than 12 months, which makes active trading impossible. And if instrument is disposed earlier, before the 12-month period is met, then income is not considered to be qualifying income, which means that ultimately the exemption can be denied if this income exceeds the threshold. Okay, and from the third example from the corporate income tax guidance for free trade zone persons relates to trading activities and the need to import goods into a designated free trade zone. Let's look at the definition at an extract from the list of qualifying activities, and it includes two types of activities that international trading companies may carry out. First of all, trading of qualifying commodities. We are not going to talk about this, but this is the type of activity which can be conducted by international trading companies, and as long as they trade qualifying commodities, then they are eligible to apply the corporate income tax exemption. And another one, which some other traders may use, is distribution of goods and materials in or from a designated zone. First of all, designated zones, the list of designated zones is narrower than the list of free trade zones. There are some logistical locations, hubs, zones in the United Arab Emirates that are called designated zones. They are used for international shipping and logistics operations. There are some VAT exemptions that can be used by residents of such designated zones. But in addition to that, it's also possible to conduct distribution activities from such zones, in which case the exemption can apply to the company's income in relation to its corporate income tax. And the definition of this activity generally tells us that it should be provided that that activities are conducted and the goods or materials entering the state are imported through the designated zone. This is the old definition, and it can be interpreted differently. First of all, it can mean that whenever goods are imported into the United Arab Emirates, then they should enter the country through the designated zone. Or it may say that basically international shipping is not possible, and direct supply bypassing the territory of the designated zone from the supplier to the customer is not possible. And yeah, obviously, if the right treatment is the latter one, then basically each and every time the trade is conducted, the goods should be temporarily brought into the United Arab Emirates, into the designated zone, which obviously limits the efficiency of international trading and means that some additional logistics costs may need to be incurred, etc., etc. But the guidance basically said that it's not necessary each and every time to import goods into the designated zone. Only goods that are intended to be imported into the United Arab Emirates should actually enter the country through the designated zone, which means that the conclusion is positive, means that international shipping is possible, and it's not required each and every time to bring goods into the territory of the United Arab Emirates if they are not intended to be imported. Three conclusions here. First of all, to qualify for the zero rates of corporate tax, the activity of distribution of goods or materials from a designated zone requires that the goods are imported into the designated zone only if they are intended to be imported into the United Arab Emirates. The advantage of this incentive is that it applies to any goods, not only qualifying commodities, but the disadvantage is that it only applies to specific designated zone, not specific designated zones, not to all free trade zones in the United Arab Emirates. And finally, for income to be considered qualifying, it is important that the buyer is not the end user and is not the end customer of goods, but instead resells or processes these goods. That is one of the requirements of this qualifying activity. Okay. And yeah, to finish the part about the United Arab Emirates, let's spend a few minutes to talk about participation exemption guide, which addressed the question how to meet the subject to tax requirements for subsidiaries that are located outside the United Arab Emirates, so that dividends and capital gains are exempt under the participation exemption rules. Let's look at the simple structure where a company, either in a free trade zone or in the mainland of the United Arab Emirates, have foreign subsidiaries, and they distribute dividends and sometimes can be sold with a gain, and dividends and gains are subject to exemption, provided that the participation exemption conditions are met. There are four conditions. First of all, 12 months holding period, which is similar to the holding requirement that applies to qualifying activities in free trade zones. Second, that the tax rates should be not lower than the tax rates in the United Arab Emirates, which is 9%. The participation should be at least 5%. And there is an anti-avoidance requirement that says that no more than 50% of assets of specific subsidiaries should not more than 50% of assets can be so-called bad assets if they are not in compliance with the participation exemption requirements in case they are held directly by their company in the United Arab Emirates. And we are going to talk specifically about the tax rate requirement here. And the question is how to meet these requirements. And the answer lies in the guidance. That's first of all, this is the extract the quotes from the federal law on corporate income tax, which says that the rule is that in the country where subsidiary is located, the tax is imposed at a rate of not less than the rates in the United Arab Emirates. Basically, this is what it says. And here is a quote from the guide that says that if there is a statutory tax rate of at least 9%, the subject to tax requirement is met, which is good news again, because the question could be if we need a nominal tax rate, or if actual tax paid in the subsidiaries country should be 9% or higher. And the answer is that, yeah, the headline, the nominal tax rate, is what's important. But the guide goes further and explains that if the nominal rate is below 9%, it's still possible to qualify for the exemption. If the effective tax rates are so-called theoretical, based on international finance reporting standards, tax rate calculated based on international financial reporting standards is at least 9%. There is also a possibility to use capital and assets taxes. If there is no corporate income tax in the subsidiaries country, it's possible to calculate the effective rates based on capital and assets taxes. And finally, if this test is not met, there is another test, holding company test, which basically replaces the effective tax rate test. And let's look at a few countries and see if we can conclude that subsidiaries located in these countries qualify for the subject to tax test. First of all, Russia and Kazakhstan, obviously, with headline rates of 20%, they qualify. Cyprus, 12.5%, qualifies as well. There is a question about Malta and Hong Kong. First of all, in Malta, it is possible to refund most of the tax paid at a headline rate of 35%, and the guidelines explicitly states that if the tax is refunded in full, then the subject to tax requirement is not met. But yeah, the question here, if in Malta the tax is partially refunded, if still, and this results in an effective tax rate of 5% to active income or 10% to passive income, if such a refund, which is not in full, still allows to qualify for the subject tax condition. In Hong Kong, as many of you know, there is so-called offshore or territorial tax regime, which allows not to pay income tax. But the question here that the headline rate of 16.5%, if it qualifies for the subject to tax requirements. The answer may be yes or no. Again, it's it's not entirely clear, but there are some grounds that allow to argue that the headline rate exceeding 9% allows to meet the subject to tax requirements regardless of this specific territorial or offshore tax exemption. And finally, BVI, no tax, which means that subject tax requirement is not going to be met. And Latvia, for example, and some other Baltic states, they only pay, they only charge income tax when profits are distributed, but otherwise current operating profits are not subject to income tax before or until they are distributed. And this is explicitly addressed in the rules, in the subject to tax test in the United Arab Emirates, which denies this test to be met in such situations. So it's unfortunate because effectively tax is going to be paid on distributions, but this is not considered to be in line with the subject to tax requirements. Okay, and we'll have the fourth part, and we are probably running a bit late, but yeah, let's move on quickly. The fourth part about restructuring opportunities, and I will talk about two examples. One in Russia, where the Russian Ministry of Finance addressed a in its clarification, a case where there was a merger between two Russian companies, and the company that merged into the other one had a subsidiary. And the question, so this is the structure with the post-merger combined company owning the subsidiary, which was transferred to the new company upon the merger. And the question is if in the new structure, that the 1 year holding period for the dividends exemption will be met, taking into account the pre-merger holding periods. And the answer was from the ministry was no, which means that, yeah, if dividends are distributed shortly after the merger, then the exemption, the participation exemption requirements are not going to be, the requirement is not going to be met. Yeah, which is unfortunate, because in this case, dividends are going to be subject to 13% tax in Russia for the Russian company instead of the exemption that would apply otherwise. What can be done in this case? So the clarification is negative. What can be done? First of all, the obvious answer is that one might wait and not to distribute dividends until the holding periods after the merger is met. It is possible to, for example, provide loans from subsidiaries to the parent company, and which is not considered currently not considered to be abusive, and effectively it will allow to achieve the same results temporarily, and then loans can be returned back and dividends can be made after the holding period is met. Second, the merger could have been done in the opposite direction. If the company which merged to the Russian company was the company which didn't have the subsidiary, and subsidiary remains in the surviving entity, then yeah, the holding period would not have been interrupted, and the tax rates, the participation exemption condition, the holding period condition would have been met, which is another solution here. And finally, it's not necessary to agree with the Russian Ministry of Finance. There is case law that demonstrates that the reorganization, similar to what the Russian the Russian Ministry of Finance described in its clarification, does not prevent or does not interrupt the holding periods for participation exemption conditions. Yep, there is a case that demonstrated this conclusion, which is contrary to the opinion of the Russian Ministry of Finance. Obviously, this is a more, let's say, yeah, this is the approach which is more in conflict, which contradicts the position, the most likely position of the Russian tax authorities, but it can be followed if the company is ready to defend its position, including defense in a court, in an arbitration dispute. And the second example brings us back to the restructuring relief in the United Arab Emirates, and recently published guides that describes how this relief is applied. Basically, it requires that the company that's one company in the United Arab Emirates that transfers its business, including all assets and liabilities relating to this business, to another company, and both companies are taxpayers, then and in exchange there are shares issued by the transferee to the transferor. If these requirements are met, then transfer of business as a whole is not subject to corporate income tax. So we are used to, in Russia, for example, to situations where contributions into capital, which is essentially what is addressed by this relief, they are tax neutral, but it's not the case in many other countries, and the United Arab Emirates is an example. But still, there is a relief that allows not to pay taxes if business is restructured in a way that the whole business is contributed to a subsidiary, for example, as is shown in this case. So there are no taxable gains or losses for corporate income tax purposes, but it's necessary that both companies are subject to corporate income tax, and they therefore can't be qualifying free zone persons or exempt persons. Okay, so this brings us to the second part of our discussion. Let me suggest that the two questions that we have here, we'll leave them for for the Q&A session if we have time. So I will skip the questions that are on the slides here, just to make sure that we do not fall far behind the schedule. And yeah, this ends the first part where we discussed changes that affect corporates international corporates that affect where we discussed changes that affect corporates international structures. And in the second part, my colleague Vsevolod will talk about changes that affect personal assets and international structures with personal assets. And yeah, let's wait until Vsevolod shows up.
I'm already here.
Oh, great. Okay, so everything. I hope that everything is in order, and I can hear you and I can see you, Vsevolod, and the floor is yours. Let me then disappear for the next, I don't know, an hour or so that you talk about changes that affect personal structures.
Yeah, exactly. So thank you very much. And we are under a little bit tight schedule, so buckle up and I believe let's go. Speaking of the international tax structures, I believe that we should start with the major tendencies and major trends which we can see on the international area. And speaking of the international area, of course, we can't avoid speaking of the special tax regimes for the individuals and high net worth individuals in particular. So, those who were present at our webinar at the beginning of the year in January, I believe, you could have actually seen this table, which I'm personally very proud of because this actually includes the major details which are usually needed for the high net worth individuals at the very beginning of our discussion on their tax planning and their tax future at their personal level. But time goes by, and I believe it is high time to to discuss some amendments which happened since the beginning of this year. And speaking of the tax amendments and tax changes, of course, we can't avoid speaking of the United Kingdom. Of course, those who are interested, you might have actually heard that they are going through a major tax reform right now, which affects high net worth individuals in particular right now. Also, we had a lot of questions on Portugal because Portugal suspended their well, not even suspended, but abolished their notorious NHR regime, which was available for high net worth individuals, and they actually introduced the second version of that regime, the so-called NHR 2.0. And I also wanted to give some words on Spain because there were some amendments in Spain. They happened not this year, but previously. But nonetheless, it made the special tax regime there more available and more, I believe, beneficial for private clients. So let's begin with the UK. Those who are interested in the UK, you might have heard of their notorious, again, this special tax regime called the remittance basis regime, or the so-called res non dom, which actually stands for the resident but non-domicile. Interestingly, this is one of the oldest special tax regimes for individuals because the fundamental principle of it was embedded in the income tax when it just appeared in the UK tax system in 1799. Further, it was a little bit amended with the progression and with the development of the income tax in the UK. But nonetheless, we are dealing here with quite an old regime, which was present in the UK for more than 2 centuries. So, the general principle of the regime is quite simple. Foreign income and or capital gains are taxed in the UK only when they are remitted to the UK by a relevant person. You may see actually in this simplified example that if you are a UK tax resident and, for example, you receive an income from Japan or any other country on your bank account opened in a Swiss bank, and after that you do not use that income and do not touch it anymore, it shouldn't be subject to the taxation in the UK. Of course, you can use this income, but there are some conditions on how actually you can use it, for it was not subject to the tax in the UK. And there were actually 4 conditions. Some of them were applicable in combination, some of them were applicable separately, but nonetheless, all of these conditions led to this amount of different interpretations on when your income is actually remitted to the UK. So you could, for example, bring this income to the UK by yourself. This income could be brought for your benefit. And even if you use this income abroad, for example, for a debt which stems from the UK, in this situation, it could be taxed in the UK. And we are not even speaking about the mixed funds concept, which was introduced in the UK. A mixed fund is actually a fund. It might be money or any property which contains more than one type of income or income received in more than one tax period. So again, as you can see at the simplified example, the tax professionals and those who enjoyed the special tax regime in the UK, they had to unravel this knot back to the first income which was used to buy, for example, a property in the UK, or if it was somehow else remitted to the UK. The regime was quite difficult to apply, and well, being honest, it was a nightmare for me as a tax specialist to deal with it, because obviously, I believe after 2 centuries, it is a high time to, take a step back and to think about that, on how we can amend the regime and make it more useful in today's life. So I believe we'll skip this part because we will refer to it about somehow later. But we have to speak about the spring budget, which was announced in the UK in March this year. So the spring budget actually told that the notorious remittance basis regime in the UK is abolished starting from the next tax year. So the remittance basis regime is no longer with us. Instead of this regime, the new tax regime was introduced. This is the so-called foreign income and gains regime, or the VIG. Under this new regime, you may see these criteria in regard of it. Only the new tax residents of the UK could apply for that. The 10 years threshold was introduced, so if you were not a tax resident in the UK for the last 10 years, you can actually enjoy the new tax regime. Foreign income under the new tax regime is exempt under no conditions. irrespective of whether you remitted to the UK or not. This is obviously good because, as I mentioned before, it was pretty difficult to use the old regime because it no longer satisfies the modern world, I believe. But the new regime is applicable only for 4 years. If the previous tax regime was available for the taxpayers for at least 15 years under the so-called deemed domicile concept, the new regime is more than 3 times lesser in a duration. And of course, the application of the regime is optional as it is incompatible with some other benefits under the UK legislation. Well, nota bene, it was quite the same with the remittance-based regime as well. So, other important stipulations from the spring budget. There might be actually the transitional provisions and arrangements for those who currently use the remittance-based regime. There were quite a lot of them. So those persons who have been tax residents in the UK for fewer than 4 years can benefit the new regime until the end of the 4th year of them staying in the UK. For others, only 50% of their foreign income, but interestingly not chargeable gains, in the upcoming tax year will be subject to the taxation in the UK. So it is quite nice to have this transitional arrangement because it's not that harsh for the current tax residents in the UK who enjoy the regime. Also, within the next 2 tax years, the current users of the remittance-based regime, they will be able to remit to the UK their old incomes under the special flat tax rate, which is only 12%. This is quite beneficial because in the UK, the personal income tax rate might be up to the 45%. This is the so-called temporary repatriation facility, or the TRF. And last but not the least, those who have benefited from the remittance-based regime can actually elect to rebase the price of the assets which they hold personally for the purposes of disposals, and the date of rebasing is 6th April 2019. Which is actually quite good because the private individuals do not have to go and sell all of their property right now because it will be taxed and you will be able to deduct only the historical price, which might be extremely low. So it is foreseen, and the price of your personally held assets might be rebased. And again, the last but not the least, some other provisions in the UK legislation were reviewed. For example, the inheritance tax was amended, and the protected trust regime is abolished. But nonetheless, if we will dive deeply into these matters, we will not be able to finish these today, so let's just put it aside. So, 4 points from the spring budget of this year. However, in the UK this year, they are having the general election, and mostly the future of the personal income tax in the UK will depend on the results of the election. And the main opposing party is the Labour Party, and they actually said the following. They supported the abolishment of the remittance-based regime. So we can say with being most certain that it will be abolished. And interestingly, they even supported the introduction of the new special tax regime. However, they disagreed with the transitional provisions. So those 50% exemption and the 12% flat rate for the remittance of the old income, this is under big question and might not be actually available starting the next year. And obviously, they disagreed with some of the proposals on the reformation of the inheritance tax and other, well, law provisions. So, what do we have in the result? The remittance basis is, well, we might actually say that it is gone. It will be no longer available starting the next year. There might be transitional arrangements for the current users of the remittance basis, or might be not. It depends on the general election results, which our peers from the UK are having this year. There might be a new special tax regime for the individuals, and the duration of which is only 4 years. However, recent news from the UK said that even the Conservative Party, which is well, actually, they were the authors of this reform. They actually told that they might make the new regime more beneficial, so the criteria of this regime are still under the question. And we actually, as of right now, do not know whether or not the inheritance tax will be amended or not, and what other amendments we might face the next year. So too much questions and too less certainty, but I believe that's what we have in the UK right now. So let's move on to Portugal and compare the old initial regime and the new one. Under the old initial regime, those individuals could apply for the regime who were the new residents in Portugal, and only the 5-year threshold was applicable. Under the new regime, this criterion is actually saved, but more criteria were actually introduced in addition to an old one. So only the employees of certain areas that are important for Portugal and Portuguese government may use the new regime. This is the higher education sphere, the science and research, and special companies. Also, employees and the management of startups may be eligible for the regime, but the status of a startup in Portugal is actually subject to licensing. So it is not that easy to create a company and to apply the regime from the day one. And the employees and the management of certain entities investing in the Portuguese economy, they can apply for the regime as well. The investments actually mean that you or your company have to invest in Portuguese economy more than 3 million euros within the 10 years in specified areas, including IT, extraction of resources, and tourism. The incentives of the old regime were actually based on the following principle. You was able to exempt your foreign income from tax in Portugal if the income could be taxed in a foreign state according to the double tax treaty or the OECD model of the double tax treaty in case of the absence of the case treaty, and the source country is not in the Portuguese tax havens blacklist. Also, in Portugal, foreign source employment income was exempt from tax if it was taxed in the source country effectively. And there were some minor incentives, such as flat 10% rate for pensions and, well, some other incentives as well. So, under the new regime, income from foreign sources is exempt from tax under no additional conditions, well, in most cases. And these types of income include investment income, rent, and capital gains. Obviously, it is a good amendment because we have no longer to deal with the previous, well, quite complicated test, which resulted in, well, quite surprising results sometimes, which we will discuss further. And the beneficial rate on some other types of income, such as employment income received in Portugal, it is actually saved. But before, it was subject to some additional conditions, and it was sometimes difficult to apply that. But as of right now, it is made much easier to apply, and obviously, it is a good change to the special tax regime in Portugal. Back to the disadvantages of the regime. As I mentioned before, some types of foreign income under the old regime were still subject to taxation in Portugal. And interestingly, capital gains were usually subject to taxation in Portugal because capital gains usually taxed under the double tax treaty in a country where an individual is a tax resident. Also, under the old regime, the CFC rules were applicable to an individual. Yes, in Portugal, just as it is in Russia, CFC rules are applicable to individuals, and they are applicable on a general basis, meaning that your foreign company should not be a part of tax avoidance or anything like that, like the CFC rules work in some of the European countries and, by the way, in the UK, as far as I know. And the duration of the old regime was actually 10 years, and current holders of NHR status can enjoy the regime until its expiration. Under the new regime, we have only one disadvantage, which actually leads to CFC rules, because CFC rules in Portugal, no one actually still knows whether it is part of foreign source income or it is an outstanding source of income which we have to evaluate separately, or there are even some opinions on the market that CFC rule, CFC income should be considered as dividends in Portugal. So I believe that this uncertainty towards the CFC rules is still with us, so we have to keep it in mind if we are talking about a special tax regime in Portugal. And the new regime, just as an old one, is provided for 10 years, which is quite all right. So, as a result, under the new tax regime, the exemption for most types of foreign sourced income is unconditional, which is actually great. The beneficial tax rate for the employment income received in Portugal is saved, and it has became more accessible, which is great as well. But unfortunately, in order to be entitled to the new special tax regime, you have to satisfy very narrow list of criteria. It is quite difficult, so obviously it is not beneficial for high net worth individuals, and obviously we as a tax specialist do not support this measure. And it seems that ambiguity over CFC rules has not been resolved, unfortunately, so we'll have to monitor that, and I believe that Portuguese authorities will be able to solve this issue, and it is better be as soon as possible. As for the Spain, so under the special tax regime in Spain, the investment income from foreign sources is fully exempt from tax. It includes dividends, interests, capital gains, etc. And as you can see, it is exempt under no conditions. Also, as a part of the regime, the employment income may be elected to be taxed at a flat rate of 24%. If it doesn't exceed 600,000 euros. And after that sum, it should be taxed in accordance to the highest tax rate in Spain, which is 45%. Unfortunately, in Spain, we have disadvantages as well. For example, it is the wealth tax, which taxes not your income, but your capital. However, under the special tax regime, the wealth tax applies only if the cost of assets located in Spain, which is important, exceeds 700,000 euros. So it is possible not to obtain too much property in Spain in order not to be subject to the wealth tax, if you are obviously entitled to the special tax regime. But in comparison to, for example, to Portugal, the duration of the regime in Spain is only 5 years, which, in my personal opinion, is, well, it could be provided for much longer, but nonetheless. So, and the amendments, which I actually promised you before. So, in order to be entitled to the special tax regime in Spain, you have to be a new tax resident in Spain, and there is a 10 years threshold actually applies. And one of the following conditions should be satisfied by you. So your relocation must be due to an employment contract being entered into in Spain, or the relocation is caused by an appointment of you as a director in a Spanish entity. And previously, you could not be appointed to a director's position in your own company, and there was actually a 25% threshold for these purposes. But after the amendments, it was actually allowed to become a director in your own company and to be entitled to the special tax regime, only subject to one condition, if the company is not an assets holding. So if you have an active company in Spain and you can actually elect you to be the director in that company, you are entitled to the special tax regime, so it became much more accessible for high net worth individuals. And one considering relocation somewhere should actually consider Spain as well. So, as the result, the tax exemption for investment income from foreign sources is in Spain under the special tax regime is unconditional. The eligibility criteria have been softened, and a person is entitled to apply for the regime if he is a director in his own company, subject to some conditions. The duration of the regime is quite short. It is only 5 years versus 10 in Portugal, or even 15 in Italy, or even indefinite period if we are talking about Switzerland. And the existence of the wealth tax in Spain should also be considered, because I believe that this might be the main issue for high net worth individuals considering relocation to Spain. So back to our table, back to square one. Unfortunately, we have to say goodbye to the United Kingdom in this chart, because the old regime is abolished, and we unfortunately have too much uncertainties towards the new regime. So maybe it is not the best moment to relocate to the United Kingdom right now. Portugal. On the one hand, the special tax regime in Portugal became much more beneficial, but on the other hand, it is quite difficult to be entitled to this regime, because you have to be employed in specified areas, or you have to make an excessive investments in Portuguese economic. But Spain actually is quite great as of right now. Of course, as I mentioned before, you may incorporate a company in Spain and become a director in your own company in order to be entitled to the special tax regime. So I believe it is quite good, quite a good jurisdiction to relocate right now. And here I also wanted to share some thoughts on the following. I believe that one of the most common questions from my clients towards special tax regimes in the foreign states is actually the following. From your own perspective, where would you like to go? Obviously, the chart which I'm going to present to you further is quite subjective, but nonetheless, I wanted to share some thoughts on this. So, if I traveled a lot, where would I go? I believe that my number one choice would be Cyprus, because Cyprus, I believe, provides a unique opportunity to become a tax resident there, and to actually obtain a tax resident certificate only if you are present in Cyprus for 60 days. Subject to the condition, though, that you are not a tax resident anywhere in the world at the same time. As my second choice, I believe, I would choose the United Arab Emirates. They still do not have any income tax for individuals, and the system there is quite easy to apply. And it is possible to obtain the tax resident certificate there if you spend only 90 days in the country. However, I should I should note that in the United Arab Emirates, there are actually two types of tax certificates, and it is possible to obtain the so-called the internal one after 90 days, but the criteria to be entitled to the one used for the purposes of the application of double tax treaty, you might have to spend much more time in the Arab Emirates physically. But from the perspective of the practice, sometimes the certificate for internal purposes is enough for the majority of the clients I had in this direction. So, if I wanted to live in one of the most developed countries, Obviously, again, it is quite subjective, and I do not tell that other countries are not developed enough, but nonetheless, I believe I would choose between Switzerland and Spain. Spain is all right, but as I mentioned before, the duration of the special tax regime is quite low there. On the other hand, Switzerland has an indefinite special tax regime for individuals, but it might be quite expensive. From the practice perspective, you have to yearly pay for the appliance of this regime up to 1 million Swiss francs, which again might be quite expensive. If I wanted to stay in a country like for good, to take my wife, to take my children, and go to live in the country with a special tax regime, I believe Switzerland would be the choice number one for me because, as I mentioned before, only Switzerland allows you to apply the special tax regime, the so-called lump sum tax regime, for an indefinite period of time. On the other hand, I would consider Italy and Greece as well, because they provide one of the longest special tax regime with a duration of 15 years. So in comparison, for example, to Spain, which provides it only for 5 years, it might be a great solution to go there. And if you especially like one of the possible destinations, you are actually you can actually go to any of these countries, because I've been talking about this since the beginning of my career in the personal taxation, that we are dealing with people and not companies. And even if you can incorporate a company in a specific state because of the tax incentives, but again, tax incentives should not be the only goal of your international structuring, because we all know how the general anti-avoidance rule work. People still cannot just go to a country and stay there if they do not like, well, staying there. So there will be no arrows, and if you especially like one of the destinations, even the United Kingdom right now, today, you still can go there, and we are, as a tax specialist, here with you to help you to, not to pay more than you should do. And transferring to the Russian section, if you have an income from Russia, I would choose between Israel and, I believe, Hong Kong, because these are the only countries which, from our list, which still have the double tax treaty with Russia in force. However, in order to apply for a special tax regime in Israel, you have to have Israeli roots. So this might be an obstacle. And Hong Kong has, well, quite unique, but in a bad way, criteria to apply for the tax resident certificates. Shortly speaking, you have to consider not only one tax year, but 2 in a row. So it might be quite difficult to obtain a certificate there. And I believe that's it from the perspective of the special tax regimes. So let's come to the what is happening right now in Russia. And obviously, we are facing the tax reform in Russia right now. To be more precise, the draft legislation was published only yesterday. Before, we had only news from public media and from some drafts which were circulating through the internet. But right now, we already have the draft legislation. However, it is not final, and you should consider it as well. So under the new tax reform, it is actually proposed to introduce in Russia the progressive personal income tax rates. Previously, we had only 13 and 15 personal income tax rates, but as of right now, as you can see, we have 5 thresholds and 5 different rates up to 22%. However, good news is that the higher rate applies only to the excess of your income over the previous threshold. Interestingly, the progressive personal income tax rates are introduced separately for the capital gains, dividends, and deposit interests. Previously on our webinar in Russian, I actually mentioned that there might be separate progressive tax rates for capital gains from the disposal of the real property, and it is still here. It is like embedded in this phrase. So previously we had a 13% on the income from the disposal of property, but since the following year, if it stays as it is right now, the tax rate will be progressive, but not that high as for the employment income, for example. And obviously the higher rates apply only to the excess, just as before. So the fixed CFC income tax regime. Previously, one, owning foreign companies which are considered CFCs, one could elect to pay only 5 million rubles in tax for all of that companies. So under the new proposal, one will have to pay 5 million rubles for each company which is considered as CFC. Interestingly, we had a question on the previous webinar that if, for example, the majority of my companies are unconditionally exempt from tax according to CFC rules, whether or not I will be obliged to pay 5 million rubles for them as well. Well, under the current draft legislation, it seems so. However, I should note again that we should wait for the final text of the legislation because it clearly seems unfair, and if your company is unconditionally exempt from taxation, for example, if it is in the CIS region, I think it would be fair to exempt them as well, even if you apply the fixed CFC income tax regime. And as I mentioned before on the previous webinar as well, there will be an abolishment of some incentives for individuals subject to the highest tax rate. So previously, I told you that there will be amendments to the so-called 5-year tax exemption on capital gains from disposal of shares or participation interests. So it will be abolished for you. You will not be entitled to that if the sum of your other tax bases will be more than 50 million rubles, meaning that you are subject to the highest tax rate. However, from what we have seen from yesterday's legislation, it is no longer that. Under the new text of the legislation, the tax incentives applies only to the first 50 million rubles in capital gains from the disposal of shares and participation interest. Meaning that, for example, if you sell next year participation interest in a company which you owned for like 10 years and you sold it for 60 million rubles, you will be able to exempt only 50 million from that sum. And one new amendment is that this incentive will be available only for Russian residents. But before it was available for the foreign tax residents as well. But as it was proposed, not from the next year, unfortunately. So I believe that's all we have to tell on the tax reform in Russia. Obviously, we had not that much time to go through the draft legislation as it was published only yesterday, but I believe we will keep you in touch on what we will be able to find else. But also in Russia, the restructuring benefit, which we call so, was prolonged to the 2024. So the law was adopted by Parliament on 21st May, but it is not yet in force, I believe. So we'll have to wait a bit more, but nonetheless, it will not be amended in any sort, so we can consider it as final. So for those who might have forgotten about this benefit, the key principle of that is the following. The income received from your foreign company is exempt in Russia if it is received in the form of property, but with an exception for money or property rights. And this benefit actually has the second part as well, which says that for the purposes of, in case you sell, you dispose of the property or property rights received under the benefit before, you will be able to deduct the price of that property or property rights on the date of the transfer, which is quite good. And actually, with careful approach, it might result in no tax paid with the combination of part first and part second of this incentive. So I might also remind you of the general conditions of this incentive. So as of right now, you should receive an income in 2022, 2023, and now also in 2024. You have to be a controlling person of a foreign company on the end of the 2021. Interestingly, there were some discussions on this provision, and we actually wished and waited for it to be amended. But nonetheless, still you have to have a CFC on the end of 2021 in order to be entitled to this incentive. And the foreign company should have owned the property or property rights, which are subject to transfer on March 1st, 2022. Later, it was a little bit amended, and the new provision says that it is also possible to apply the benefit if the property rights are transferred, which stem from the sale of property or property rights, which the company owned on March 1st, 2022. I actually had a great example on this new provision because it opens a lot of opportunities for restructuring cases, but I believe that you will be able to find it in our presentation, which will be sent after the webinar. But unfortunately, we do not have that much time for that anymore. So I might also remind you that since this year, the special and temporary tax incentives, they are abolished. So this is previously the exemption for the deemed income a buyer receives in some cases was enforced, but since the beginning of this year, it is no longer an exemption, and you have to pay tax on that, and you have to keep this concept in mind because it is not obvious, not always obvious, and so please keep that in mind. And since the beginning of this year, the exemption for penalties for not submitting the financial statements of your foreign companies, it is abolished as well. So just as before, individuals and, well, companies, which are the controlling persons of controlled foreign companies, they have to submit the financial statements of their foreign companies. And interestingly, let's remind that there was a letter from the Federal Tax Service which said that even if you applied the exemption for penalties before, it doesn't actually mean that you were exempt from the obligation to file the financial statements. So as soon as you have the financial statements for the for previous years, please file it to the tax authorities. And if you find out that you are obliged to pay tax, you should pay that as soon as possible, because you are freed from penalties, but not from the interests on the late payment. So sooner you do that, lesser you will have to actually pay. So I believe that's it. And yeah, so we might go to the Q&A section if we have any. So Victor?
Hello.
Yeah.
I'm back. Can you see me?
I cannot see you, but I can hear you. Yeah, and now I can see you as well.
Great. Yeah, I think everything is working, but let's check. Please, whoever is listening, please. Yeah, I see there are fire buttons and yeah, lighting up. So everything is working. You're right. We have a few questions, and although we passed the 2.5 hour limit, I think we still should spend, well, at least a few minutes to answer the questions that we received before the events, and we also have a couple of questions that we received during the webinar. And let's start. Yeah, I'll read out each question, and we will decide who answers which one and what we do. During the webinar, Christophoros asked two questions. They both seem to relate to corporate parts. They were asked in the beginning of the webinar. Let me read them out. The first question, you said that freight forwarding doesn't attract any withholding tax. Does this apply to air cargo freight forwarding contracts as well? I think my tentative answer would be yes. It should not be limited to specific types of transportation. The only question here is to what extent the nature of the contract falls under the definition of freight forwarding services in the Russian Civil Code. I think the legal treatment should be observed. And if the answer to the legal question is yes, then the tax treatment should follow. That's basically the main principle. And not being a lawyer and not seeing your particular case, I will not answer with certainty. But to the best of my knowledge, there is no specific limitation in the Civil Code that only calls freight forwarding services those services that are not, as you describe, air cargo transportation services. That would be my answer. So it's not the answer as such, but yeah, it's the method that I would apply to get to the answer. So first look at the civil code, then make sure that the definition describes your situation, and then both answers, if both answers are yes, then the tax return should follow and no withholding tax should apply, provided that the other party is not a related party. Otherwise, in Russia, services are subject to withholding tax starting this year. This was the first question. The other one seemed to be related to transfer pricing changes in Kazakhstan. But let me read them out. Let me read the question out. Do you have any details for the 50% rule from one company, more than 50% of the revenue, or of another company per year from international business? I think the question relates to transfer pricing rules in Kazakhstan, which now cover or deem transactions between unrelated parties controlled if certain other conditions are met or thresholds are reached, and the 50% revenue threshold from a specific party is one of the criteria for treating an unrelated party transaction to be subject to transfer pricing rule. That is my understanding. I do not have an answer how to interpret this new rule, and I must admit that the changes in the transfer pricing law are somewhat ambiguous. Yeah, so unfortunately, I would say that let's look at the law and try to understand to what extent, how explicit it is and what conclusions can be drawn. I can't guarantee again that the conclusions will be definitive. These are the two questions that were received during the webinar. Let me now move on to questions that we received before the event, and three questions that relate to the personal tax part. The first one: will it be possible to cancel the regime only before the 31st of December 2024, or it will be possible to make the decision later? It might relate to the fixed CFC tax base, but Vsevolod, what's your understanding of the question?
I actually remember this question. It was transferred from the previous webinar in Russian, but we had no time to answer that. So it relates to the fixed CFC profit regime. And according to the current legislation, in case the amount of tax under the regime is raised, you are able to file a notice to the tax authorities that you want to apply the regime no longer. And it is usually done before the end of the reporting year. So we have the financial year of the company, then goes the reporting year for your personal tax, and then the year when you file your tax declaration towards the income from the reporting year. So under this paradigm, if the amendments to the tax code in this part will be enforced since January 1st of the next year, you should be able to file the notice to the tax authorities before the expiration of the next year. As of right now, we don't have any amendments to this part of the tax code, so you have no grounds to file such amendment. So you'll have time until the end of the next year. So please don't worry.
Okay, sounds good. Next question: if a person owns 100% of shares of a Russian company for more than 5 years, then sells it for 100 million rubles, will he be able to use the exemption, the 5-year exemption, I suppose?
So it is also was transferred from the previous webinar, and interestingly, the answer, if I answered this question at the previous webinar, would be different. as of right now, as we can see from the draft legislation, it is true that the tax exemption applies only to first 50 million rubles derived from the sale of shares or participation interest. So answering your question, yes, if you sell shares or participation interest which you held for more than 5 years for 100 million rubles, you will be able to exempt only half of that, the 50 million.
Okay, next question. Is tax credit available if income is received in a country with a suspended double tax treaty? Let's answer the question from a position of personal taxation and personal taxation rules in Russia.
Yeah, it is an interesting question because as you might know, the suspension of the double tax treaties did not actually affect the double tax mitigation article. According to the Russian legislation, the tax credit is only available in accordance to the double tax treaty. And as I mentioned before, it wasn't affected. However, the mechanism of the double tax treaty article is that it incorporates links to other articles of the double tax treaty. And since other articles of a double tax treaty are suspended, it might be impossible to actually apply the double tax mitigation article even if it is still in force. Actually, the same position was announced by Czech Republic and Austria, I believe, which suspended the double tax treaties from their perspective as well. And they mentioned actually this trouble with application of the article as well. So answering your question again, as of right now, we do not know. Because from the perspective of Russia, if you are a Russian tax resident and want to apply a tax credit, I believe that there will be a clarification from Ministry of Finance or the Federal Tax Service, which says that, yeah, we see that contradiction, but nonetheless, we allow that. Because otherwise, it would make no sense to leave this article in force. But if we are talking about the foreign states, it depends. So we'll only have to follow the practice and see what will be happening next.
Yeah, makes sense. There is one more question which we received during the events about personal taxation, and in particular Spain. I don't know to what extent you can answer to this question on the spot, but let me read it out. How high is the wealth tax in Spain?
It is an interesting question, and being honest, I do not remember. So this should be an easy answer, and I think I will be able to come back to you in this perspective. But as of right now, unfortunately, I do not have the knowledge of the specific numbers. Yep.
But whatever the rates, it's best to avoid
that. Yep.
And this is why special tax regime in Spain exists and attracts so much attention.
Yeah.
Okay.
To avoid that, but not in a bad sense.
Yeah, not in a bad sense, absolutely. I promised to answer a couple of questions that were on the corporate tax part in the slides of the corporate tax part, and let me do it now. I think we'll have a few minutes to answer them. These two questions, and then we will finish off and call it a day. So one question relates to withholding. They are both relating. They both seem to relate to withholding tax parts. There is a specific one about the redomiciliation. Is it necessary to withhold tax at source when paying income to a redomiciled foreign company, the redomiciled foreign company in the Russian Federation, if it's not deregistered in a foreign country, for example, Cyprus. So the situation described here, it's not uncommon. And as many of you know, it is possible to redomicile companies from any country basically that allows redomiciliation into Russia to so-called special economic zones in Russia. It's possible to make a foreign company a Russian entity under a redomiciliation procedure, which has been in place for several years, since 2018, if I'm not mistaken. Currently, it's not uncommon to see difficulties that companies, for example, in Cyprus, have trying to deregister from the Cypriot register. Strictly speaking, redomiciling a company requires deregistration from the foreign register, and the company should cease to be regarded as a Cypriot entity and should start to be treated as a Russian company after redomiciliation takes place. But unfortunately, we see in practice instances where it's very difficult or even impossible to deregister a specific company from, let's say, the Cypriot register. And it's not contrary to the Russian rules. Right now, they allow for at least 2-year periods for deregistering from the foreign register after the company is brought into Russia. But during this time, company kind of exists in two countries simultaneously, which is obviously not something that should happen. Redomiciliation should mean that the company changes its address to another country, but in practice it's possible. And the question relates to withholding tax consequences. I would say that it depends on which country applies withholding tax, and most likely in this situation described, it's going to be Russia. And the answer in this case is, well, it's highly unlikely that in Russia the redomiciled company, which is not yet deregistered from Cyprus, is considered a Cypriot company. The Russian treatment should be consistent with the Russian sides, and regardless of the status of the company as a Cypriot registered entity, by the Russian side, it should be treated as a Russian company, and therefore with the corresponding withholding tax consequences. So that's the answer. In other countries, the conclusion may be different, but for the Russian side, it's very unlikely that it's going to be treated as a double country company. It's going to be treated as a Russian company, which means that withholding tax should not apply. At least it should not be treated. Payment of income should not be treated as a cross-border payment, in which case, there will be domestic implications. Sometimes domestically taxes withheld at source, for example, dividends, interest, and royalties, they are taxed at the recipient's side. So this answer is more or less clear, and I think it's not something that I would call surprising, that the Russian side will respect the redomiciliation from the Russian side. And the final question, it's also about redomiciling of a company, but in a country, in some other country, not into Russia. If the lender, said in the question, was in the European Union and redomiciled to another jurisdiction, how should the double tax treaty be applied correctly? For example, what about the interest that arose in the European Union and is paid to the new jurisdiction? How great is the risk of claims of treaty shopping if the lender is interdependent? How can you protect yourself from such claims if the redomiciled company has little substance in the first year for objective reasons? So the question describes a situation where companies redomiciled from the European Union to some other country, and we see this in practice. Quite common destination is the United Arab Emirates. In some cases, Kazakhstan is chosen to redomicile companies from the European Union, for example, from Cyprus. There were cases in practice that we saw. And here the answer is that, basically, from Russian withholding tax perspective, the new structure, the post-redomiciliation structure, should be used as a basis for withholding tax purposes when interest is in the question is paid. So upon payments of interest, withholding tax consequences apply. There is no, so to say, memory for withholding tax purposes in Russia, depending on when interest was accrued. This is why redomiciliation should change withholding tax implications. Is it going to be considered treaty shopping? Depends on specific situation. I would not expect that the redomiciliation as such will be aggressively challenged by the Russian tax authorities, because we see many instances where European companies redomicile outside of the European Union, and the reasons seem to be obvious and not something that the tax authorities would deem tax avoidance or tax evasion. This is why I would be cautiously optimistic about the possibility to use treaty protection in the redomiciled structure. But as is described in the question, the new company, after the redomiciliation, the company has little substance, and this is concerning. This should be addressed, and yeah, it's difficult to build up substance in a new place, but it's necessary to make sure that treaty benefits apply and beneficial ownership conditions are met, so that withholding tax benefits can be relied upon based on an applicable double tax treaty. That would be my answer. I think we ran out of questions, and we even earlier we ran out of time, but it was good to address all the questions that we received, and some we kind of took from the previous events. I think it's time to end the webinar. And would you like to say something to the participants?
No, I just wanted to to say thank you for everyone who was able to participate in our webinar today. And I also wanted to thank you, Victor, for being with us for all of this time. So.
Yeah, thank you, Vsevolod. It was a pleasure to have you on the webinar, and it was a pleasure to be with you, with all the participants during almost 3 hours. And as I always say, each situation is unique, and we advise clients on specific circumstances and try to help our clients to find solutions in their specific and unique situations. And this is what we do. And our contact details will be on the final slides. And I encourage everyone to continue the discussion, and let's see how we can be of help. With your structure, and how we can manage its tax efficiency in your specific circumstances. Thank you very much, and see you on our next events.
See you next time.